Thank you for joining us for tonight's presentation, Financial Planning Concepts for College and Post-College Years. I welcome you all here in our office, as well as those of you joining on the web. I'm Nancy Bailin and will serve as your host for tonight's program. With me today is our presenter, David Bailin, Chartered Financial Consultant, Chartered Life Underwriter, and holder of a certificate in long-term care planning. The presentation will last approximately 45 minutes and be followed by a question and answer session. To ask a question, click on the chat button on the small Join Me toolbar and type your question anytime during the meeting. The questions will be saved and addressed during our question and answer session following the presentation. I ask that you keep your questions general in nature, as we will not be able to address individual concerns during this presentation. If you are interested, David has volunteered to answer more specific questions by email. Please send your emails to david.bailin@personalwealthstrategies.com. David is the founder of Personal Wealth Strategies and has worked to help successful individuals and their families accumulate and protect their wealth. A graduate of Lehigh University in Bethlehem, Pennsylvania, David is a frequent speaker for employee groups and has been featured in print, radio, and online. Tonight, David will speak about important financial concepts that today's college students and recent graduates need to understand. With that, let me turn it over to David.
Thank you very much, Nancy, and welcome to all those here and online. Today we're going to talk about financial planning concepts for college graduates and those who have recently college students and those who have recently graduated college. And one of the things I like to say that is, if you want to find out what's going on in the financial world, is you can follow us via social media, via Facebook, Twitter, or LinkedIn. Now, tonight's topic is a very interesting one because most of us spent years of time in study and training trying to get to college and then ultimately through college. But when we graduated, we had little training on how to manage our finances. So tonight we're going to talk about those things that a college student or recent college graduate needs to pay attention to. Now, if anyone's on the line who doesn't fit into that category, these tools will serve you well as well. These tools will serve you well because they're not unique based on age, but rather the sooner you get started, the better off you're going to be. Now, what I've found over time is money is important to people for different reasons. So I want to throw the question out there. Why is it that money is important to you? Well, let's think for a minute. Why is it that money is important to us? For many of us, we were taught at a young age that money was the be-all and end-all, and that we had to go out and earn as much as we possibly could. Sometimes parents were the ones who taught us that it was okay to work round the clock, 7 days a week, forsaking all else but the mighty dollar. For others, we learned it the hard way. When we wanted to obtain something, we knew we had to work for it. But what is it that makes money important? Well, I find that it goes to your core values and what's important to you. So for some, what makes money important is the fact that it allows them choices. It allows them to select between different options of how they want to lead their life and what lifestyle they wish to lead. For others, they're going to say that the importance of money is material goods. They might talk about the car they wish to buy, or the new home, or even the vacation that they want to go on. Too often, we define the importance of money by what our neighbors have. And the desire to keep up with the Joneses is a strong motivator to go out and earn more money. But I think probably the best thing or the most important thing that money does for us is it gives us freedom. the freedom to do what we wish to do, how we wish to do it, and when we want to do it. When you realize why money is important to you, you'll understand a lot better of how you should handle it. I like to think of financial planning like a jigsaw puzzle containing several pieces. In a jigsaw puzzle, if you're missing one piece, and haven't we all done a jigsaw puzzle where you're missing one piece, but if you're missing one piece in the puzzle, you'll never have a complete puzzle. I like to think in the world of finance that life will find the weakest link in your financial plan and ultimately exploit that vulnerability. Well, if you design your financial plan correctly, there will be no weakest link in your financial plan. So when we look at the different areas of financial planning, that of cash management, risk management, our accumulation goals, financial independence, and estate planning, by working to develop a plan that incorporates all 5 of these areas, we develop a truly secure financial plan. Perhaps the most important link, however, is that of cash management. The idea of how do we manage our day-to-day lives. Well, in a very simplest terms, cash management is the idea of whether your revenues exceed your expenses. In the old days, we used to keep a ledger for our checkbook where we'd write down every deposit that we put into the bank and then every withdrawal or check that we wrote. If we were diligent about it, at any point in time, we could tell you what checks were outstanding that had not yet cleared so that we knew what our balance truly was. But now, people tend to keep track of their finances electronically. And so often, the way they manage cash is simply, do I have any money left in the bank? And if so, it must be good to use. It reminds me of the old joke where the comedian said that I couldn't possibly be out of money. I still have checks left. Well, today, you don't want to be in a position where you say, I can't possibly be out of money. I still have a balance in my account, not knowing what other payments are outstanding right now. So the most important tool to manage our finances is perhaps the budget. And there's certain elements to a budget that we recommend that everybody adhere to. Number one, we believe that everybody should have a budget that is written. In other words, at the beginning of the year, write down what you expect to earn in revenue and what you expect to spend. And then throughout the year, track those figures, revenues and expenses, to find out if you're tracking favorably or unfavorably to those original figures. Now, I like to use a tool such as Quicken or Mint, or even for those who are working with Personal Wealth Strategies, our Dreamcaster program, where we're able to look at your finances in real time and know immediately has gone through the bank accounts and from what category or what expense you've made that expenditure. For those who are not good at managing money, we find that not only do they run the risk of running out of money when it's needed the most, but also of damaging their credit. So most people know that it's important to have a good credit score, but sometimes why it's so important to have a good credit score, or for that matter, what even affects our credit score. So a credit score is a independent agency, produced by an independent agency that says whether or not we pay our bills on time and we pay them in full. And those who pay on time and pay them in full will have good credit scores. And those who lag behind or try to ignore those bills go away, will tend to have bad credit scores. Most people realize that the importance of a score becomes painfully obvious when you go to borrow money. If you go to buy a car or take a mortgage out for a house, the better your credit score, the lower your interest rate. And of course, those who don't have good credit scores may find either a higher interest rate or the refusal of the bank to give you any money. And particularly in today's environment, where the banks are tighter with cash than they've ever been, it's more important than ever to have a good credit score. In fact, I'll take it one step further. In our practice, we have many clients who are employers and employers. One of the things that we will advise is that before they hire a new individual to their company, that they run a credit report on that person. Now, of course, you have to get that person to agree to allow you to run a credit report, but what job applicant wouldn't agree to whatever the employer had requested in order to get the job? Why do you think it's important that we have the employers run a credit report? Anybody? Well, yeah, a credit report can be used to measure a person's character. Those people who do not pay their credit on time, you could question their character. What else? Any other thing? Yeah, that. So we can say that if a person is not paying their bills on time, that they could bring those problems into the workplace and potentially affect their performance in their work. The reason, though, I'm so concerned about an employer ordering a credit report on an individual is if an individual has financial problems at home, not only are they likely to bring it into the workplace, there's also the possibility that they may feel that they need cash and they're so desperate for cash that it jeopardizes their relationship with your customers or even the company's own financial resources for fear that they might take what they would consider to be a loan because they might be well intended to pay it back, but they jeopardize the way they handle cash in the office. So we do recommend that employers order credit reports because we think it's so critical that you know what you're getting yourself into when you hire an employee.
I think I got it. I buy something I want and then hope that I can pay for it, right?
No. You make sure you have money, then you buy it.
Oh, then you buy it. But shouldn't you buy it before you have the money?
No.
Why not?
It's in the book. It's only one page long. The advice is priceless and the book is free.
Wow, I like the sound of that.
Yeah, we can put it on our credit card.
That's right. You want to make sure that you can pay for things before you buy them. Credit cards, I often will call plastic fantastic. And the reason I've given them that nickname is because when you go to buy something, if you just reach in your wallet and pull out a credit card, the item that you're trying to acquire suddenly becomes yours. It's like magic. And it will stay magical for about 30 days, plus a grace period, until a bill comes due. Now, if you are putting money on a credit card, you're making purchases on a credit card with the idea that you plan to pay it off at the end of the month, and you're disciplined enough to do that, that's fine. But if you get to the end of the month and you find that you don't always have the ability to pay those bills in full, that can be a very dangerous precedent. I think back to a young woman who I met several years ago who at the time had about $25,000 outstanding on a credit card where she was paying about a 20% interest rate. Well, I imagine that pretty much everybody in the audience knows what a good financial planner is going to tell her to do, which is to pay down her credit card. 6 months later, I went to visit her, and I asked how she was doing in paying off her credit card. And she told me that she had made little headway, most likely because there was a 20% interest rate on that. So I suggested to her that if she was having trouble paying it, that she might want to call the credit card company and see if they would be willing to lower the interest rate so that it would be more affordable to her. Now, as crazy as that sounds, many credit card companies will do just that, lower the interest rate on the credit card simply by you asking. Well, 6 months went by and I saw her again, and I asked her how she was doing with her credit cards. And she said she's made a little headway, but there's still a very large balance outstanding. I asked her if she did call another credit card, if she called to get the interest rate lowered, and she said her company was unwilling to lower the interest rate. And I asked if she called any other credit card companies to see if she could get a lower interest rate elsewhere. And she said that, in fact, she had not, because the credit card company that she had right now was giving her miles, airline miles, for the monies that she had outstanding on the card. Well, when I pointed out to her that with a $25,000 balance at 20%, her interest payment over the next year was going to be $5,000, I told her that the reason the company was giving her miles was for $5,000 they could be paying for several airline tickets, and yet they were only giving her one. So if we can manage our credit and we can manage our cash well, what it provides us with is the foundation to our financial plan. Another piece of the foundation is the risk management, how we handle those items that are too big for us to save for and to finance. For those who are familiar with our company logo, which you can see on your screen in the lower left-hand corner, you'll see it's a gold pyramid. But if you look closely, not as a gold pyramid, but you can see that pyramid is made up of bricks. And the reason we designed it that way is because that's the way a financial plan is put together, by piece, by piece, by piece, so that you build a solid foundation from where you can grow. So often I'll see people come to me and they'll say, Dave, I have a friend who's got this great idea for me to invest in this stock, and I really want to take advantage of it. What do you think? And I say, well, tell me, how much do you have in your bank account? And they'll say, well, not all that much, but this is a great opportunity I can't miss. Well, the foundation of that person's financial plan is very shaky, but the stock tip is very, very speculative. So my advice to a person like that would be to build your foundation before you go into that type of speculative investment. Likewise, when we look at the areas of risk, we have to make sure that our foundation is solid there. So risk at a younger age typically means protection through insurance. Okay, so as an example, everybody knows that it would be near impossible to be in a financially secure enough position that if you became sick for a prolonged period of time where hospitalization or medical care was required, it would be very, very difficult to finance that out of savings or even your investments. And as a result, we buy health insurance that provides for coverage in the event we should become sick or hospitalized. Likewise, by state law in many states, I'm required to carry liability insurance for my car. And therefore, if I get into an accident and I injure somebody, my insurance company will pay them for their injuries. Now, interestingly, the states do not require you to pay for collision insurance. So I may be covered if I hurt somebody else, but if I damage my car, I may not have adequate insurance. That's the idea of risk management. If you own a house, clearly you would need to have homeowners insurance, because if that house were to burn to the ground, it would be such a financial loss that would be difficult to recover from. But two areas that I find young people don't give adequate attention to is areas of life insurance and disability insurance, which we'll talk about a little bit further in a moment. But what's interesting about disability insurance in particular is it's the only form of insurance that protects the person who purchases the policy. If you think about it, if you get sick, who does your health insurance pay? It pays the doctor. If your house burns to the ground, who does the insurance pay? It pays the builder to rebuild the house. Car accident pays for the other person's car or injuries. If even your car that gets damaged, it will pay your car dealer to get you a new car. But disability insurance is the one form of insurance that when you pay the premium and you have a claim, the check comes back to you. So I often will say that disability insurance is the most important form of insurance, and we'll talk a little bit more about that in a moment. Now, the next area of financial planning, the next piece of the jigsaw puzzle, as it were, is your accumulation goals. Now, we all have different goals that we've set in life, whether it would be to buy a new house, a nicer car, to educate our children. But the only way we're going to have the funds to do that is by putting that money aside today, but essentially sacrifice today and put the money aside for tomorrow. The only money that you're going to have down the road is the money that you're going to have put aside today and let accumulate. So speaking as a parent with a child who's currently enrolled at Boston College, I will tell you that if I had not saved money along the way, it would be near impossible to pay for a year's tuition, room and board, out of income. But by having saved money along the way, I've made it that much easier to pay for the expenses because I've spread it out over several years.
You gave me too much money. Huh? Not going to cost all this. Have you got 2 tens for a 5? Just so happen to have it. I said, nah. I'm not sure. She's a regular scout, that's why. That woman knows her stuff. Just a minute. Right, what's wrong? Just a minute. $15 went south. You gave me a lot of your fast pocket. Have you got 2 pence for 5? And me, like I said, I got 2 pence for 5 over there. Wait a minute, are you accusing me of cheating? No, you got 2 cents. Here's your 5. Give me back my 2 cents. Here's 2 cents. Give me a 5.
Now, hopefully, you manage your own money better than that example. The next area of financial planning that we touch on is financial independence. Now, earlier I spoke about saving money for retirement, but in working with several clients who have reached retirement age, I've begun to realize that people today don't really retire in the traditional sense. And by that I mean, when we were growing up, or perhaps our parents were growing up, the vision of retirement was someone who worked until they were age 65. On that day that they met the retirement age, they threw a party for that individual, gave him a gold watch, or her a gold watch, and then they rode off into the sunset, never to be seen or heard from again. Today we find that as people reach a level of financial independence, they don't ride off into the sunset. Many of them choose to work part-time jobs as consultants or volunteer work where they have a full day of work, they're just not getting paid for it. Or perhaps they have hobbies or other things that keep them busy. We also see people today, many striving to retire from their full-time work at a younger age. Now, how do you do that? Well, the way you do that is to begin to think of your work not as a goal that you wish to retire from, but rather to think about having enough money in the bank and through your investments that if you were never to get a paycheck again, that you could still live comfortably off of what you've accumulated. Once you reach that level of financial independence, it will allow you to make decisions in a different in a different mindset. For example, if you knew you had enough money in the bank that you never had to work another day in your life, think about what you would do differently. Would you still be working in the same job? Would you pick a new career? Would you go back to school? Would you stop working altogether and travel? When you think of financial independence and start making decisions as a financially independent person, you tend to make different decisions than when you have to go to work for the paycheck. So we strive to reach a level of financial independence as early as possible. And the last piece of the financial planning puzzle is estate planning. And in estate planning, we look to design a plan that allows your assets to pass from you to your desired survivors in the most efficient and least costly manner possible. For young people, this starts by getting your basic legal documents in order, such as a will, a power of attorney, durable power of attorney, and a living will or medical directive. As you get older, it might involve trust or charitable planning. But all this comes into play in developing the financial plan. I think back to a young couple that we had in our office not too long ago, and in gathering my information about what work they had done previously as a financial plan, I asked if they had wills drafted. And they looked at each other, and the husband said, "No, we don't." And I said, "Well, do you mind if I ask why not?" And the wife said, "Well, when we need one, we'll get one drafted." And I thought to myself, what makes you think that you're going to have the opportunity to draft the will before you need it? Death is never, or is not always, on a known date. And if it should occur beforehand, whatever you've put in place as your estate plan is your final estate plan. So if you don't have a will drafted, if you haven't made the election of who's the beneficiary on several of your different accounts, you have chosen that to be your estate plan if you were to die today. So the final piece of the financial planning puzzle is to make sure that you have your estate planning put together. When we put all this together,
Gentlemen, it's come to my attention that a breakaway Russian Republic, Pakistan, is about to transfer a nuclear warhead to the United Nations in a few days. Here's the plan. We get the warhead, and we hold the world ransom for $1 million.
Don't you think we should maybe ask for more than $1 million? $1 million isn't exactly a lot of money. Virtucon alone makes over $9 billion a year.
Really?
Mm-hmm.
Okay, then. We hold the world ransom for $100 billion.
you may find more traditional ways to come up with your money, but there are going to be certain tools that you're going to use in order to achieve those goals. So earlier we talked about putting your money aside for retirement, or as I referred to it as financial planning, as financial independence. On the screen here, you have a couple choices of how you might do that. What's unique about saving for your financial independence is that there are tax benefits that can be derived by dedicating money towards retirement. The most commonly cited example is a company-sponsored company-sponsored retirement plan, the most common of which is a 401k plan. But perhaps your employer offers a 403b plan if you work for a nonprofit or hospital or education employer. If you work for a municipality, you might have a 501c3 plan. These plans allow you to put aside money out of your paycheck and put it aside for a later date. If you decide to put money aside outside of your employer, you could do so through what's known as an individual retirement account, or you're probably more familiar with the acronym IRA. IRAs come in two varieties, a traditional and a Roth IRA. The difference is that in a traditional IRA, you put money in on a pre-tax basis, only to take it out at retirement and pay taxes later. In a Roth IRA, you put money in a post-tax basis, so that when you take the money out at retirement, it comes out without any taxes due. So let's use an example. Let's say I put $2,000 into a traditional IRA and it grows to $7,000. Well, when I put the $2,000 in, I got a tax break. So if I'm in a 25% tax bracket and I put $2,000 into my traditional IRA, I actually save $500 on my taxes. 2,000 times 25%. That $500 I could use to increase my contribution and make it $2,500, or I could use that $500 for anything else that I want. But now that my $2,000 has grown to $7,000 when I retire, and I take that money out, I now have to pay tax on that $7,000 in my then current income tax bracket. In a Roth IRA, I'm putting money in on an after-tax basis. So let's say I put $2,000 into a Roth IRA. I've had to earn $2,500 in my paycheck because $500 would have gone to the government in the form of taxes so that I could receive my $2,000. Now, everybody knows this if they look at their pay stub. You look at what your gross income is, how much you earn, and your net income is how much you take home. What goes into a Roth IRA is your take-home pay. But if I put $2,000 into my Roth IRA, when I retire, if it grows to $7,000, I now can take that full $7,000 and not have to pay any tax on it. So we oftentimes will look at Roth IRAs for younger individuals when they're in lower tax brackets because they will ultimately be taking the money out at retirement when they might be in a higher tax bracket. Now, another overriding concern for younger people today are student loans. I don't believe there's ever been a time where student loans have created such a burden on recent graduates of school as they are today. And there's two main reasons for that. One is the size of the loans today are bigger than they've ever been before, thanks to an increased cost of tuition and overall education expenses. The other reason student loans are so expensive is the government has reduced the amount of subsidy that they put into the interest rate so that today, even though interest rates in the general market are low, students are paying a higher interest charge on their loans. So what's the best way to manage student loans? Well, I suggest that when it comes time to make your first payment is to contact the bank and get pricing or get options, get repayment options, I should say, on the different types of loans. And once you get a feel for how much each one of these options would cost you, you can then plug it into the balance of your financial plan and determine which would be the best fit for you. Now, the standard 10-year repayment is the one that's going to produce the highest monthly payment to you. It's also the one that will have the loan paid off the fastest. If you extend your payments over 30 years, that will be the one that produces the lowest payment in most circumstances, but will take you the longest time to pay back the loan. Now, I mentioned earlier there's two areas I find young people don't give adequate attention to in terms of the risk that they face. One being the costs that are associated at the time of their death, and the other if there's sickness or illness. So we're going to talk a little bit about life insurance now. And my feeling is that life insurance has been made overly complicated by the insurance companies as they've tried to outmarket each other to the average consumer. But I'm going to try and simplify things here for you. To start, every single life insurance policy sold in the United States will fall into one of two categories. It's either going to be a term insurance contract or a permanent insurance contract. Term insurance contracts are written for a series of years. They could be for 5, 10, 15, 20. Nowadays, there's contracts that can go for 21, 22, 23, so you can really specify the number of years that you want, all the way up to 30 years. Most contracts today have a level premium for those years that you've purchased. So, for example, if you purchase a 10-year term insurance policy, that premium will stay level for 10 years, and then after those 10 years are up, either the contract ends, or you might be given the right to keep it beyond the 10th year at a premium multiples of one's paying. In permanent life insurance, there's 4 main types: whole life, universal life, adjustable life, and variable life. These are all forms of permanent insurance, but rarely will you see a company use those terms. Their marketing departments have now packaged them in such a way that you're going to hear terms like eclipse life, extraordinary life. You'll hear about stupendous life. All these different types of names that are designed to make you think their contract is better than the others. But in its most basic form, permanent life insurance gives you a guaranteed premium that will never go up over the course of your lifetime, and a guaranteed death benefit that will never go down. Because of the way these contracts are written, you're able to build cash values inside the contract. Cash values are the monies that sit in reserve in a contract until needed at a later date. This means that if I looked at a term life insurance contract and I compare it to a permanent life insurance contract, what I'd find is that term life insurance should only be purchased in 2 examples, in 2 cases. The one case is if I have a short-term need for insurance, a term life insurance contract might be appropriate. For example, if I go out and I buy a house with a 15-year mortgage, how long do I need my life insurance for that guarantees payment of the mortgage? Well, 15 years. Do I need it for a 16th year? Not unless I'm going to refinance, no. So a 15-year term insurance contract might be appropriate in that case. The second reason why I might consider buying term insurance, and the one you're more likely to run into, is that term insurance is always going to be initially less expensive than permanent life insurance. So if I have a large need for insurance and a limited budget, it's more important to get the right amount of insurance than it is to get one that's going to have a permanency to it. I can always get something more permanent down the road, but I can't necessarily get more insurance when I need it. So it's not atypical today to see someone in their late 20s needing $1 million or more of insurance. Well, if I'm a 30-year-old male who needs $1 million of insurance and I'm in very good health, I might find that a whole life insurance, one of the permanent life insurance policies, might cost me $1,000 a month for $1 million of coverage. And I might find that a 20-year term insurance policy might cost me $50 a month. Well, which one am I more likely to buy? It depends. If my cash flow is limited, $50 a month sounds like it's a better deal. Over the short term, term life insurance is always going to be less expensive. But over the long term, permanent life insurance will be less expensive than term life insurance that you need to keep for long periods of time. And that's because with term life insurance, if you're buying the least expensive period, a 5 or a 10-year insurance policy, every 5 or 10 years you need to renew that contract based upon your health and your age at that time. So clearly at 30, it's less expensive than the whole life insurance. But a term policy purchased at 40 or at 50 or at 60 or at 70 will begin to be more expensive than would be the whole life insurance policy that had a level premium. Additionally, the cash values inside of permanent life insurance policies can act like a savings and be accessed when you need it. It might be a source of emergency funds when you're presented with an extraordinary or unexpected bill, or it might be a supplement to your retirement income. All very valid reasons to consider using permanent life insurance. Now, I'm going to ask everyone to take out a piece of paper, and I'm going to have you write down on that piece of paper 2 numbers. The first number is how much you have in savings. And by this, I mean the money in your savings account, your checking account, money market account, CDs, even your stocks and bonds that you might own. How much have you saved to date? Okay, everybody have a number down? Okay, good. Now, on the second line, I want you to write down what's your monthly budget. Now, think back to when we were talking about cash management and I was talking to you about the importance of managing your budget. What is the amount that you have down for your monthly budget? Everybody have a figure. Okay, good. Now what I'm going to ask you to do is to divide your monthly budget into your savings. Okay. And that's going to be your factor. So for example, if your savings is 3 times as large as your monthly budget, your factor would be 3. Okay. Everybody have a factor? Okay. Let me tell you what that factor means. If the factor is below 3, it means you fall into the category that 90% of Americans do, which is you're living your life hand to mouth, that you have very little in savings, and if your income were interrupted for any reason, you would have a difficulty maintaining your lifestyle without financial hardship. If your factor is 360 or above, it means that you are now financially independent and could maintain the lifestyle that you're now living, even if you never went to work another day in your life. But if the figure is somewhere between 3 and 360, it means that, unfortunately, you have to get up tomorrow morning and head back to work because you depend on your paycheck to cover your expenses. But what if somehow that paycheck was interrupted? What happens if due to accident or injury, you're unable to go to work tomorrow? Sometimes people don't give this adequate consideration, but it's not just a slim possibility. There is a very real probability that at some point in time during your working life, you may not be able to return to the workplace. On the screen, you'll see some statistics that show the probability of you being out of work for more than 90 days prior to age 65. So if you're currently age 35, you can see that there's a 24% probability that you'll be out of work for more than 90 days. If you're a 2-income family and you depend on both incomes to meet your household needs, you can see there's a 43% chance that one of you is going to lose your income for more than 90 days, thus increasing your vulnerability due to illness or injury. Now, sometimes I show this slide and people get excited and say, hey, Dave, how many wives or husbands am I allowed to have here? You got 3, 5, 10 people down. Well, the reason we have those statistics there is because when we're talking to groups, say an employer, and the employer is made up of 5 partners, or maybe it's even 10 partners, we no longer talk about the importance of, or the probability of someone becoming sick or injured, but rather talk about the probability, the likelihood, we talk about the fact that it's going to happen. It's just a matter of when and how well prepared are you. So one of the ways you protect yourself from an unintended interruption of your income due to illness or injury is through disability income insurance. And when we look at individual disability income insurance, this is not the type that you're going to buy through an employer plan that's going to offer you some level of protection, but leave you some gaps. This is going to be a policy that you're going to be able to design. So when you say design, Dave, what does that mean? Well, the first thing you're going to look for is the policy cancelable and is it renewable? And ideally not cancelable. What I'm looking for is non-cancelable. I want the insurance company to guarantee that they cannot cancel my policy down the road if they've had unfavorable experience or if my health has changed. And I want it guaranteed that they're going to renew it each year in that same fashion. I want to know that they can't change the rates or change the terms no matter what might come down the road, as long as I pay my premiums on time. The next thing I have to figure out is how long can I go before I need the policy to send me a check if I'm sick or injured. Commonly, we look at 90 days to 120 days because we want to make sure we have enough money in our bank accounts that we can bridge that gap through our own savings. By buying insurance contracts with shorter elimination periods, say 60 or 30 days, the price gets to be extremely expensive, and that's the type of risk that we can insure ourselves by simply putting money aside in our bank. The next thing we have to figure out is how long do I want this policy to last for? If I get sick or injured, for how many years do I want payments to continue? For most people, the answer to that is going to be until retirement time, because they're going to need to replace their funds for that long. But there are periods of time that you can purchase of 5 or 10 years that will be less expensive and maybe help you bridge the gap just enough. Beyond that, we're going to want to find out what's the definition of disability. Now, this is the key trigger in a disability insurance contract. You know, with life insurance, it's pretty black and white. Either you're alive and paying premiums or you're dead and collecting a claim. When disability insurance becomes a little bit more of a gray area because a person can be injured, but maybe not so much so that they can't work doing something. So we tell people that the more educated and training that's involved, more education and training that's involved in your career, the more specific you want your definition of disability to be. For example, if you're a vascular surgeon, you're probably unwilling to accept a disability insurance policy that says if you're able to practice medicine, we consider you to be be employed. And the reason for that is a vascular surgeon is very specialized and makes a higher income than a general practitioner because of the extra years of training and specialization. So they would want a very exact type of policy. Likewise, a trial attorney needs to have a policy that says if the individual is sick or injured in such a way that they can't be in front of a jury, then they receive a full claim even if they're still able to do some type of corporate law. Next, we want to make sure the policy covers partial or residual benefits. These terms, partial and residual, are very similar in nature, but the importance here is that the most likely type of illness or injury you're going to have is going to fall into one of these two categories. And that is, what if your sickness or injury prevents you from working as many hours as you once did, or maybe as effectively as you once did, but doesn't prevent you from doing the work that you're capable of doing completely. So, for example, if you find yourself in a high-pressure job and you begin to suffer from stress, it's very likely your doctor is going to tell you that you can continue to do what you're doing, but maybe limit it to only 20 hours a week. Or perhaps, due to a knee injury, you can't stand for very long periods of time and therefore can't do the type of work that you're accustomed to for a full, let's say, 8-hour workday, if that's in fact what your workday looks like. For that reason, partial and residual disability claims are the #1 type of claim that is filed, and you need to make sure that your policy covers for these types of claims. And finally, you want to make sure the policy has a cost of living adjustment so that if you do go out on claim, the benefit that you receive goes up each year to keep pace with inflation. Clearly, if you're 30 years old now or 25 years old now and you buy a policy and were to go out and claim, by the time you're 40 or 50 or 60, if that claim does not increase over time, you're earning a smaller and smaller check when we look at real terms. And since all your expenses are going to go up, if your revenues don't go up to keep pace, it's going to be more and more difficult as you get older. So when we put this all together to complete our financial plan, we see that we have the puzzle complete, and we know that we're adequately covered for any risks that might occur. And with that, I'm going to open the floor up to any questions. Excuse me. All right, I see we have one coming in over the internet from our webinar. It says, I received a graduation gift last year. Interest rates are very low, and the stock market is too risky. What am I to do with my money? All right, excellent question. I'm going to take you back to the beginning of the talk and say, we need to build the foundation of your pyramid. So before I can answer the question of what to do with your money, we would need to check your foundation. So the first thing I'm going to ask is, do you have money in a bank account? Now, this may sound strange coming from a financial advisor, but the most important financial tool that you have to work with besides your budget is your bank account. If you don't have enough money in the bank to cover 3 months worth of your monthly expenses at a minimum, and some will tell you want to take this even up to 6 months, that's where your money belongs, regardless of the interest rate. So don't go chasing interest rates to the exclusion of your need for liquidity. Okay. Once we know that we have sufficient liquidity, it allows us to move up to the second tier, the second level of the pyramid, and begin to look at other assets that offer higher rates of return. Before we go to put our money in those types of assets, though, we have to ask ourselves, what's the time frame that I'm looking to put this money aside for? Because if you say I'm able to put this money aside for a long period of time without needing it, you're able to get better rates of return because of that long-term commitment. Next, you'll want to develop a diversified portfolio. So you don't want to put all your eggs in any one basket, put it all in one company's stock, or even in all your money in stocks in general. You want to be well diversified, so you have your money in many different classes so that your assets are well protected, even in down stock markets or lower interest rate environments or in credit crisis or whatever might come. Because what I'll tell you is, over time, it will all come, and you'll be exposed to all these things, and the question is, how well do you prepare for it? But in closing on this question, I'm going to go back to the most important thing, is that make sure you have enough money in your bank account so that you don't have to incur credit card debt, and so that you're able to take care of all your expenses. One of the things I like to say is there's nothing more expected than an unexpected expense. We don't know what it's going to be for. We don't know how much it's going to be. But we do know somewhere down the road, your car's going to need new tires, your house is going to need a new roof, or you're going to have some medical expenses. And it always seems to happen when you least can afford it. And because we need to have a financial plan that's going to work in all weather, we have to make sure we have that solid foundation. Okay, do we have any other questions? All right, if not, I will thank you all for your attendance today. If you do think of a question after the meeting is closed, feel free to give us a call tomorrow in our office at 609-586-9308, or you can send us an email, and on the screen you'll see my email address at david.bailin@personalwealthstrategies.com. I look forward to speaking with you soon, and I wish you all the best of financial health.